Hello everyone and welcome to this session on the Boston Consulting Group BCG Matrix, a strategic marketing tool. Today we are going to explore one of the most widely used frameworks in the business strategy, the BCG Matrix. Businesses, especially large ones, don't just sell one product, they have a variety of products in their portfolio. Some of these products bring in massive revenue while others might struggle to grow. This is where the BCG matrix helps. In this video, we'll break down how businesses categorize their products using this tool, why managing a product portfolio is crucial for growth, and how companies make strategic decisions based on their products' performance in the market. By the end of this session, you will understand how businesses like Apple, Samsung, or Nike use the BCG matrix to decide where to invest, which products to grow, and which ones to phase out. So let's get started and dive into the world of strategic decision making. Now let's begin by understanding what the BCG matrix is all about. The BCG matrix is a visual marketing management tool that helps businesses analyze their product portfolio in simple terms, the range of products they sell. Not all products perform the same in the market. Some are highly successful while others struggle to gain traction. This tool was created by the Boston Consulting Group BCG, a global management consultancy. The main purpose of this matrix is to help businesses decide where to invest their money, which products to develop further, and which ones they may need to discontinue because they are no longer profitable. Think about companies like Apple. They sell iPhones, iPads, MacBooks, AirPods, and other accessories. Some of these products are huge revenue generators while others contribute less to the company's overall earnings. The BCG matrix helps companies like Apple determine which products to focus on and where to allocate resources for maximum business growth. So in summary, the BCG matrix is a powerful decision-making tool that businesses use to stay competitive and profitable. In the next slide, we'll explore how this matrix works and why it is so useful. Now let's talk about why having a balanced product portfolio is so important for businesses. First, a diverse range of products helps increase brand awareness. Think of a company like Nike. They don't just sell shoes but also apparel, sports equipment, and accessories. The more products they offer, the more customers recognize and engage with their brand. Second, diversifying products reduces risk. Imagine if a business only sells one product like umbrellas. On rainy days, sales might be great, but on sunny days, demand drops. However, if the same company also sells sunglasses, they can balance seasonal demand and maintain steady revenue. A diverse product range protects a business from relying too much on a single product. Finally, a balanced product portfolio increases revenue streams. Different products appeal to different customer groups, which means more people are likely to buy from the same business. Apple, for example, sells iPhones for those looking for premium smartphones, iPads for people who need tablets, and MacBooks for professionals. By catering to a wider audience, they ensure higher sales and long-term business success. So in short, having a well-managed mix of products helps businesses grow, reduces financial risks, and strengthens their brand in the market. Now let's take a closer look at the four categories of the BCG matrix. These categories help businesses analyze their products based on market share and market growth. First, we have question marks. These are products that have a low market share but exist in a high growth market. They might have potential, but they are not yet profitable. For example, a newly launched tech gadgets that's in high demand but hasn't yet gained a strong customer base. Companies need to decide whether to invest in these products to turn them into stars or let them go if they don't perform well. Next, we have stars. These are high market share products in a high growth market. They are doing really well and have strong sales, but they still need investment to maintain their growth. Think of the iPhone. When it first became popular, it was in high demand and dominated the market. The goal is to keep investing in stars so they eventually become cash cows. Then we have cash cows. These are high market share products in a market with low growth. These are the company's most profitable and stable products because they don't require much investment or expenses but still generate a lot of revenue. A great example is Microsoft's Windows operating system. It has been around for ages, dominates the market, and continues to bring in consistent profits. Finally, we have dogs. These products have low market share and exist in a low growth market. They may still bring in some revenue, but they are not significant profit generators. Think of an old MP3 player in today's market. Very few people use them anymore, and the market for them isn't growing. Businesses often phase out dogs to avoid unnecessary cost. Understanding these four categories helps companies make smart business decisions about which products to invest in, develop, or discontinue. Now let's focus on the first category in the BCG matrix, question marks, also known as problem child. These are the products that have a low market share but exist in a high growth market. In simple terms, the market is growing rapidly, but these products haven't yet captured a strong customer base. Think about a new startup launching an electric scooter. The market for electric vehicles is booming, but this specific scooter brand hasn't gained much popularity yet. Why do we call them problem children? Well, these products are still in the introduction stage of the product life cycle, meaning they require heavy investment in marketing, research, and production. However, there is no guarantee they will succeed and become profitable. Because of this, question marks are considered high risk products. They have the potential to grow into stars, but they could also fail and turn into dogs. So, businesses need to make a critical decision. Should they invest more to push these products into the market, or should they drop them if they don't show enough promise? In the next slide, we'll see how other categories like stars and cash cows play a role in balancing a company's product portfolio. Now, let's move on to the next category in the BCG matrix, stars. These are the products that every business dreams of having because they have both high market share and high market growth. In other words, they are already popular and leading in a fast growing market. A great example would be Apple's iPhone. In its early years, the smartphone market was booming and Apple held a strong position with high sales. Since stars are in the growth stage of the product life cycle, they still need continuous investment in areas like marketing, product development, and distribution to maintain their dominance. The ultimate goal for businesses is to turn their stars into cash cows, which means once market growth slows down, these products should still generate steady markets with less investment. So to sum it up, stars are high potential products and businesses need to keep nurturing them to ensure long-term success. Now, let's talk about one of the most valuable categories in the BCG matrix, cash cows. These are the products that dominate the market. They have a high market share, but they operate in a low growth market. In simple terms, the market is stable and the product is already well established. So, businesses don't need to invest much to keep them profitable. For example, Coca-Cola's original soft drink is a perfect cash cow. Also, Parle-G biscuits is a perfect cash cow. The soft drink Coca-Cola market isn't growing rapidly, but Coca-Cola continues to generate huge profits because it's a market leader. What makes cash cows so important? First, they are the most profitable products in a company's portfolio. Second, they generate steady revenue with minimal investment. Third, they provide the cash needed to fund other products like question marks and stars. In short, cash cows are the company's financial backbone. They keep the business running while supporting the development of new and growing products. Now, let's talk about the final category in the BCG matrix, dogs. These are the products that have both low market and low market growth. In other words, they are not performing well and their potential for future growth is very limited. Most of the times, dogs are products that have entered the decline stage of the product life cycle. They might still generate some revenue, but they are not sustainable in the long run. For example, DVD players used to be a star when home entertainment was booming, but today, with streaming services like Netflix and Amazon Prime, DVD players have lost relevance and become dogs. So what do companies do with dogs? Some businesses continue selling them if they bring in small profits. Others phase them out to free up resources for more promising products. It's a strategic decision. Sometimes keeping a dog might make sense for brand loyalty, but in most cases, companies discontinue them to focus on more profitable opportunities. And with that, we have covered all four categories of the BCG matrix. Now that we have understood the four categories of BCG matrix, let's talk about what businesses actually do with these products. Each category requires a different strategy. First, question mark. Use a building strategy. Since question marks have low market share but high market growth, companies need to invest heavily to increase their market share. If successful, a question mark can turn into a star. But if the investment fails, it may become a dog. For example, think about electric vehicles. From new car brands, companies invest heavily in marketing, research, and infrastructure to make them popular. Third, stars. Use a holding strategy. Stars already have high market share and high growth. So businesses focus on maintaining their dominance. They need continued investment to stay at the top and avoid being overtaken by competitors. For example, the latest iPhone model is a star. It dominates the smartphone market and Apple invests in advertising and innovation to hold its position. Next, cash cows. Use a harvesting strategy. Cash cows have high market share but low growth, meaning they generate stable profits with minimal investment. Companies focus on maximizing profitability and using the revenue to fund other products like stars or question marks. Example, Microsoft's Windows operating system, most people already use it, so Microsoft doesn't need to invest much, but it still generates huge profits. Dogs. Use a divesting strategy. Since dogs have low market share and low growth, companies often phase them out or sell them off to focus on more profitable areas. For example, BlackBerry phones were once popular, but after losing market share, the company decided to exit the smartphone market. Each of these strategies helps businesses balance their product portfolio and ensure long-term success. While the BCG matrix is a great tool for analyzing a company's product portfolio, it's important to remember that market share and growth don't tell the whole story. Let's break down a few key factors businesses need to consider when making strategic decisions. First, high market share doesn't always mean high profits. Just because a company sells a lot of product doesn't mean it's making huge profits. Some products, especially those with low margins, don't generate much profit despite high sales. For example, think about fast food chains. A restaurant might sell thousands of burgers every day, but if the profit per burger is low, the overall earnings won't be very high. Next, costs of production and pricing strategies matter. Even if a product falls into the star or cash cow category, high production cost can eat into profits. Companies need to carefully manage costs and set the right price to stay competitive. For example, some luxury car brands have high market share, but their production costs are also very high. If they don't price their cars strategically, they may struggle to maintain profits. Not all stars turn into cash cows, and not all question marks succeed. While the goal is to grow stars into cash cows and turn question marks into stars, it doesn't always work out. Some stars fade due to competition, and some question marks fail despite investment. For example, remember MP3 players? They were once stars, but as smartphones took over, MP3 player quickly declined and became dogs instead of cash cows. So while the BCG matrix provides a useful framework, businesses must also consider profitability, costs, and external factors before making major investment decisions. Alright, before we wrap up, let's quickly go over the key takeaways from everything we have learned about the BCG matrix. First, the BCG matrix helps in strategic decision making. This tool provides a clear way for businesses to analyze their products and decide where to invest, hold, or phase out. It helps companies make smart choices about their product portfolio based on market growth and market share. A well-balanced portfolio ensures sustainability. A company shouldn't rely on just one type of product. By having a mix of stars, cash cows, and promising question marks, businesses can maintain steady profits and reduce risks. Without a balanced portfolio, companies might struggle when market trends shift. Third, understanding market dynamics is essential for business success. The market is always changing. What's a star today might become a dog tomorrow. If a company doesn't adapt to new trends and customer preferences, companies need to monitor competition, pricing, and consumer demand to stay ahead. So, that's the BCG matrix. It's a powerful tool for businesses to manage their products, make informed investment decisions, and plan for long-term growth. Hope you found this helpful. See you in the next session. For this presentation, I refer to reliable sources including the Business Management Subject Guide issued by IB and Paul Hong's 5th edition Business Management textbook. These are excellent and adequate resources for deeper insights into business strategies. And that brings us to the end of this session on the BCG matrix. I hope you now have a clear understanding of how businesses analyze and manage their product portfolios for long-term success. If you found this video helpful, don't forget to like, share, and subscribe to our channel for more valuable business insights. Also, I did love to hear your thoughts. Drop a comment below and tell me, how do you think companies should manage their product portfolio? Should they invest more in stars, take risks with question marks, or focus on maximizing profits from cash cows? Let's discuss in the comments. Thanks for watching, and I'll see you in the next video.